All right, let's work through a few problems from Chapter 3 to apply the concepts we are learning. In this first problem, Horn Company accumulates the following adjustment data at December 31st. So we're at the end of the accounting period. We are going to indicate for each of these adjustments what type of adjustment this is. Is it a prepaid expense, an accrued revenue, and so on, and the status of accounts before the adjustment. In other words, are the accounts overstated or understated before we make an adjustment? Looking at the first one, the company counts supplies of $100 on hand as of December 31st. We are looking at prepaid expenses. When supplies were purchased, we were prepaying for the future supply cost. Thus, the type of adjustment is a prepaid expense. Before the adjustment is made, assets are overstated because it means that when we bought supplies, we recorded an increase to the asset supplies account. But now $100 remain on hand. More was purchased than what remains. That means some of the supplies were used up. If we don't make an adjustment, the assets are overstated. It also means that the expenses are understated because we bought the supplies, they were recorded as an asset. We use them. When we use up an asset, it becomes an expense. And we haven't yet recorded that expense being used. We're still recording it as a prepaid expense, as an asset. In the second one, services were provided but not recorded, totaling $900. Services have been earned, but we haven't billed them, and we haven't recorded them. That means we are looking at accrued revenues. And accrued is just a fancy term to mean accumulated revenues. These are revenues we have earned but haven't recorded. That means our revenues are understated. We have earned revenues, we haven't recorded them, so without an adjustment, we will understate our revenues. It also means we have understated our assets. We are owed an amount for those revenues. We haven't recorded it, which means we have more assets or more receivables. Interest of $200 has accumulated on a note payable. That means we have a note payable, we have a liability for which interest has accumulated. We haven't recorded that interest. So we are looking at an accrued expense, recording an expense that has accumulated. Before we record an adjustment, we have not recorded an expense, meaning our expenses are understated. We also owe for that expense, which means before the adjustment, we have not recorded the liability, and our liabilities are understated. In this final one, we had collected rent in advance. $650 of that rent has been earned. When we collected the rent, we recorded an unearned revenue because we had been paid in advance for revenue we hadn't earned. We had recorded a liability. Since we recorded that liability, the unearned revenue, we have now earned $650 of it. If we do not record the adjustment before the adjustment is made, we are still reporting liabilities that we don't have anymore. So our liabilities are overstated. It also means we have earned some of the revenues, and our revenues haven't been recorded, so our revenues are understated. Let me know if you have questions on that one. All right, in this next problem, the ledger of Daniel Rental Agency on March 31st of the current year includes the following selected accounts. These accounts are shown before adjusting. Entries have been prepared. These are the account balances related to some of their accounts. These aren't all of the accounts. These are just the ones that we're going to have to deal with. Okay, so it's just a partial trial balance. The instructions tell us that we are going to prepare adjusting entries at March 31st, assuming adjusting entries are made quarterly. Okay, so we are at the end of March, we're at the end of the first 3 months. The company is preparing the first quarterly set of financial statements, and they need to make adjustments, and so they do it once every 3 months. An analysis of the account shows the following. The equipment depreciates $400 per month. Equipment, when it is purchased, is recorded as an asset. As we use up an asset, no matter whether it's equipment or supplies or prepaid insurance, When we use up assets, they become a cost, they become an expense. The same thing happens with long-term assets. The equipment depreciates $400 per month, we have $400 of depreciation expense. Thus, we need to record 4 months at $400 per month, or $1,200 of depreciation expense, to reflect how much of that asset was used up over the 3 months. Now, long-term assets are the only account that we don't directly, I should say, the only asset that we don't directly decrease when we record its expense of being used up. We keep track of how much of the asset was used up in this contra asset account. This was discussed in the book, and this contra asset account is also discussed in the mini lecture videos. So if you haven't reviewed those, you need to do so to understand this. So here is our journal entry to record the cost of the long-term asset that was used up. We debit depreciation expense and credit accumulated depreciation. Next adjustment that we need to make for these 3 months. 1/3 of the unearned rent revenue was earned during the quarter. Remember, unearned revenues are liabilities. They represent amounts that customers have prepaid us for. They haven't yet received whatever it is they paid for. We were prepaid. When we received the prepayment, we ended up recording this liability. We still show a liability of $10,200 in the general ledger. However, 1/3 of that unearned rent revenue was earned. In other words, we provided the service, we paid off 1/3 of that revenue. That means that 1/3 of the $10,200, or $3,400, is no longer a liability. So we need to decrease our liability accounts with a debit. By debiting the liability account, we are decreasing it. We provided the service, we paid off the liability, and in the process, we earned the revenue. We provided the service, we have earned the revenue. So the revenue is recorded. Credit the rent revenue account to record more revenues being earned and an increase to rent revenue. Interest of $500 is accrued on the notes payable. We have a liability in the amount of $20,000. We have accrued or accumulated $500 of interest on that liability. We haven't recorded that interest. We haven't paid it yet. We will probably be paying the interest when we pay off the note payable. That means we have incurred an expense, interest expense, we will be paying sometime in the future, which means we have a liability to pay that in the future. We need to record how much of that interest expense, $500, has been incurred. So we will debit the expense to record the fact that we have incurred more expenses. To increase expenses, we debit, and we are recording an increase to our liabilities. We now owe more. We have a higher liability for interest, so we need to increase our liabilities by crediting the interest payable liability account. Supplies on hand total $900. This means that the company physically counted their supplies, and they counted $900. However, right now, the general ledger is showing a balance in the supply account of $2,800. $2,800 had been purchased, only $900 remains. That means that $2,800 less $900, or $1,900 worth of supplies, were used up. We need to decrease the supply account for the amount of the supplies that were used up because we no longer have them. We need to decrease the asset account with a credit. As we used up that asset, it became an expense. So we will debit the supplies expense account for the amount of the expense that has been incurred, or the amount of the supplies that were used up. Finally, insurance expires at the rate of $200 per month. We have an asset, prepaid insurance, which means at some point we prepaid our insurance. We have an asset of $3,600. However, that insurance was used up or expired. Our insurance cost involve insurance coverage, which is $200 per month. 3 months have passed in this quarter, which means $600 of this prepaid insurance was used up to cover our insurance costs. So we need to decrease our asset with credit to reflect the fact that we no longer have $600 worth of that prepaid insurance. It was used up. And as we used up that asset, prepaid insurance, it became an expense, insurance expense. Notice that what you're seeing here is that as we use up an asset, it becomes an expense. As we use up supplies, it became supplies expense. As we use up prepaid insurance, it became insurance expense. As we used up our equipment, it became depreciation expense. Okay, let's try another problem that kind of pulls together the concepts from the past couple chapters along with the adjustments in this chapter. Mound View Motel opened for business on May 1st of 2010. Its trial balance before adjustment on May 31st is as follows. So here is a full trial balance. Open for business on May 1st, it is now May 31st. So these are the balances in all of their accounts in the general ledger after the first months of operation. Okay. In addition to those accounts listed on the trial balance, they listed here all the other accounts that they use in the general ledger. Okay. So this is something that if we need help, we can refer to this for an account name. They gave us some other data regarding all the adjustments we need to make. The first thing we're going to do is journalize the adjusting entries on May 31st. So let's look at these. Prepaid insurance is a 1-year policy that started on May 1st. Going up here, I see in the general ledger that we have a balance in prepaid insurance of $2,280. They told us that that prepaid insurance is for a 1-year policy. The policy began on May 1st of 2010. However, it is now May 31st. We do not still have $2,280 of prepaid insurance because 1 month of it, the month of May, was used up to cover May's insurance requirements. So we need to prepare adjusting entry to reflect we no longer have $2,280 in prepaid insurance. What we have is 1 month of that, $2,280 times 1/12, getting 1 month out of that, or basically $2,280 divided by 12, $190 worth of prepaid insurance was used up. We need to decrease the prepaid insurance account. We decrease an asset with a credit. So we decrease prepaid insurance $190 to decrease it for the amount of the insurance that has now been used up. And as we used up prepaid insurance, it became an expense, insurance expense. We have more expense. We are going to record an increase to our expense with a debit. The next adjustment, a count of supplies, shows $750 of unused supplies still on hand on May 31st. Looking at the amount of supplies I have recorded in the general ledger, I am showing supplies of $2,200 in the general ledger. However, we physically counted and we only have $750. That means that the difference between the amount that we had on hand or purchased less the amount that we now have on hand, $1,450 of those supplies have been used up. We need to decrease the supply asset account. We decrease assets with a credit and record how much of those assets were used up and became an expense. We debit the supplies expense to record an increase to our expense for the amount of supplies that were used up. Annual depreciation is $3,000 on the lodge and $2,700 on the furniture. We had purchased the lodge and the furniture and recorded assets. But some of those assets were used up during this month. Some of the value of those assets were used up. That means that we need to record the depreciation of those two assets. And what the publisher did here is do this in two journal entries. We could combine this all into one entry, but let's look at it as two separate adjusting entries. First, let's record the depreciation expense of the lodge. We debit the depreciation expense to record more expense for the lodge in the amount of $250. Now these numbers aren't here yet because we haven't actually posted these. So let me take them out. We're debiting the expense account, and we keep track of how much of a property, plant, or equipment has depreciated in the accumulated depreciation account. So we will credit accumulated depreciation. Let me see if I can make this a little bit clearer. For $250. We also need to record the depreciation expense on the furniture. So we will debit the depreciation expense, increasing it, and crediting accumulated depreciation for the amount of depreciation that was incurred on the furniture. The next adjusting entry, the mortgage interest is 12%. The mortgage was taken out on the 1st of May. Let's see what we have. A mortgage is a liability. Here we're seeing we have a liability in the amount of $35,000. Interest on that is 12%. That means if we take the amount of the liability and multiply it by the 12% interest rate, that's how much interest we pay on that mortgage every year, because that rate is an annual rate. We are going to multiply that annual rate by the fraction of the year for which we are recording interest expense. So 1/12 of the annual interest means $350 of interest has been incurred on that mortgage, but it hasn't yet been recorded and it hasn't yet been paid. We need to record an expense incurred. We debit the expense. And if we haven't yet paid for that expense, we are going to credit the liability, increasing our liabilities. That adjusting entry increases the expense and it increases the liability. 2/3 of the unearned rent revenue has been earned. Let's see what we have here for unearned rent revenue. This company has $3,300 of unearned rent revenue. That means tenants had prepaid for future rental cost. We have a liability to provide the tenants the room or space that they have prepaid rental costs for. We have a liability of $3,300. That's how much liability is showing in our general ledger. However, 2/3 of that unearned rent revenue has been earned. $3,300 of rent revenue, unearned rent revenue, is in the general ledger. 2/3 of it is no longer a liability. We need to decrease the liability by $2,200, or 2/3 of $3,300. We will debit the unearned rent revenue, and as we paid off that liability by providing the rental space to the tenants, we have earned revenue. We will credit the revenue to increase it. Salaries of $750 are accrued but have not been paid on the 31st of May. What this means is that salaries of $750 have accumulated. We have employees who have worked and have earned that, but we haven't paid them. We have incurred an expense that we haven't paid. We need to we need to record an increase to our salaries expense for the expense that we have incurred. We also need to record an increase to our liability for the amount of the liability we have to pay those expenses at some point in the future. All right, what we have done is taken these unadjusted balances in the general ledger. These are the balances before adjustments were made. We have prepared in the journal entry a whole series of adjusting entries to adjust the accounts to reflect their true ending balance at the end of May. Now that we've told the accounting system what accounts need to change, need to be adjusted, we need to actually cause those accounts to change. That means we need to take each debit and credit from the general journal and post it to the general ledger. The very first one, the journal tells us we need to post a $190 debit to the insurance expense account. Going down to my general ledger, I am going to keep going till I find the insurance expense account. Way down here, here's my insurance expense account. It is account number 722. On May 31st, I am posting adjusting entry from the general journal, page 1, a debit of $190. Debits will cause the account to increase its balance because it's an expense account. Debits increase, bringing the account balance up to $190. I'm going to take my post reference, account number 722, back up to my general journal and put that post reference into the post reference column to indicate that that debit of $190 was posted to the insurance expense account. Next line tells me I need to credit the prepaid insurance account $190. I will go to the general ledger, find the prepaid insurance account. Oops, sorry. Hope I'm not hurting your eyes. I'm sorry. Here we go, prepaid insurance. For the adjustment, this account is showing a balance of $22.80. We are now posting on May 31st an adjusting entry from the general journal, page 1, a credit in the amount of $190. Credits will decrease in asset account, bringing its balance from $22.80 down to $20.90. I will take the post reference account number 130 back up to the general journal, put that in my post reference column. I have now posted each debit and credit to cause those accounts to change. We keep going, keep posting the next line. We are debiting supplies expense for $14.50. I will take that $14.50 debit, find my supplies expense account all the way down here, account number 631, May 31st, an adjusting entry from general journal, page 1, a debit of $14.50. Debits will increase expense accounts, bringing its balance up to $14.50. I will take my post, whoops, I forgot to look at the account number. I will take my post reference, 631 is the account number, back up to my general journal. And I think it was 631, right? Sorry if that number's wrong. It's not sticking with me in my head. To show that we have posted the account or the $14.50 debit to account 631. Supplies, so we need to credit the supplies account $14.50. I go down here and find my supplies account. It had a balance of $2,200 before adjustments. On May 31st, I am posting an adjusting entry. General journal, page 1, in the amount of $14.50. Brings its balance down to $750 because credits decrease in asset account. I'm going to take, get this account number back over here. I'm going to take the account number 126 back up to the general journal, put it in the post reference column to notate that that credit was posted to account 126. Okay, I'm not going to continue on with the posting process. We would have to go through and post every one of these debits and credits. When we do that, we are going to be ending with adjusted balances in all of the accounts after the adjusting entries have been posted. Some accounts had adjusting entries, others didn't. We have ending adjusted balances in all accounts. Before we can prepare financial statements, we need to prepare an adjusted trial balance. Remember, an adjusted trial balance is really just simply all of the account balances listed into one little spreadsheet or worksheet to make sure that debit account balances equal credit account balances. Going back here to my general ledger, I have a cash with a balance of $3,500. Supplies balance of $750. Prepaid Insurance, ending adjusted balance of $20.90. Land, ending balance of $12,000. What I'm going to do is take each of those account balances and put them into my trial balance. If the account has a debit balance, it goes in the debit column. If the account has a credit balance, that balance will go in the credit column. Those two column ending balances should equal. That means that our debit balances equal our credit balances. If those two numbers don't agree, typically means either we didn't post something correctly or we didn't add or subtract correctly. We would have to go back to correct our errors before preparing the financial statements. Okay. Very last step in the accounting reporting cycle is to now prepare financial statements. There are 4 primary financial statements that are prepared. Let's do the first 3. The very first financial statement that a company prepares is the income statement. The only things reported on the income statement are the revenues and the expenses. We're reporting the amount of income for the period. So here is my rent revenue along with all of my expenses. My income statement for the month ended May 31st of 2010 reports revenues, $12,500. Comes right here. Here's the ending balance and the rent revenue, along with the balance and all the expenses. Now, these expenses aren't being shown in the same order as we saw in the trial balance. The reason they did that was they reported them in descending dollar amount order. Honestly, the order is not all that important for kind of purposes of what we're doing, as long as you just remember that expenses are all listed here and subtracted from revenues on the income statement to calculate the ending net income. The second statement we're going to prepare is the owner's equity statement. The statement is going to show the transactions or the amounts that affected the owner's capital. It looks like the owner started the year with a $0 balance in owner's capital, although this is showing us a balance in the owner's capital of $46,380, which the publisher wasn't very clear with this, or the author of this problem. We'll make the assumption that the owner invested $46,380 into that account, which would cause the balance to now be $46,380. So we saw an increase to owner's capital for investments, and it also increased for net income. And the net income comes straight out of the income statement and feeds into the owner's equity statement. We would also have to subtract out any owner withdrawals, but it appears that there are no owner withdrawals recorded. There's no owner drawings account, so there were none during the year, leaving us with an ending balance in capital of $50,865. Last, or the third of the 4 statements, or the last one we will prepare, is the balance sheet. And the balance sheet reports on the very last day of the accounting period the financial position of the company, its total assets, its total liabilities, and owner's equity. These balances come straight out of our adjusted trial balance. Here are our assets. And remember what we discussed in the in-class mini lectures. We also read it in our readings this week, that we are going to report the contra asset account, or the accumulated depreciation, right along with the account that it's tied to. It's kind of like a dog on a leash. Wherever its asset account is reported, the contra asset account is reported right along with it. This is saying that the original cost of the lodge was $60,000. $250 of that value was depreciated or used up, leaving the lodge with future value to the company, or its asset value at the end of May of $59,750. Same thing with furniture. The original cost was $15,000, but $225 of its value was used up or depreciated, leaving $14,775 of value remaining. Total assets of $92,865. All of our liability ending balances, and then our ending owner's capital account comes straight from the owner's equity statement. total liabilities and owner's equity hopefully should equal total assets, and showing our balance sheet is in balance. All right, so let me know if you have any questions on anything I covered in these problems. Go ahead and work on your homework now.